Hi, welcome. One of my favorite expressions is the following: growing up is optional, but growing old is mandatory. We're all aging, and let's face it. And before you complain, it beats the alternative. And one of the things I've discovered over the last decade, especially as I age, is how much the aging of human beings is mapped out in the aging of businesses. I call it the corporate life cycle. And what I thought I would do in this session is give you my thoughts on why the corporate life cycle is a useful way of thinking about businesses and thinking about how they change as they get older. Because the implications are wide. Let's start by setting up why it's so critical to have a way of explaining things. In every discipline, there is the search. Search for what? For something that explains everything that happens around you. In physics, it's what animated Einstein and Bohr trying to come up with explanations for the entire universe. In the physical sciences, it is easier to find a framework because nature has a way of constraining the framework and making sure it works. The social sciences, it's much more difficult. For a while in psychology, for instance, everybody thought that everything could be explained by Freud. We've discovered that that's not true. In finance, just as in every other discipline, we've been on a search for something that explains everything that goes on around us. Now, as somebody in finance, I'll start with a confession. Finance is a young discipline. In fact, I think of finance at its beginnings as applied economics. And the early parts of finance, the attempt to find a big picture, a big idea that explained everything, came from economic theory. Harry Markowitz and portfolio theory gave rise to the CAPM. For a long time, people tried to explain how markets work by using theory-driven models. Along the way in finance, we had to shift because we discovered that theory-driven models did not work that well at explaining real life. We explained to data-driven models. Why? Because finance, more than any other discipline, was reliant on big data. Because we had the data on markets, on prices, on financials. And for a while now, we've tried to explain what's going on, data-driven insights. The proxy models form our French factor models. And along the way, we also stole from psychology with behavioral finance and said maybe that'll explain what's going on. I find promise in all of those, the Markowitz, the portfolio theory, CAPM, the data-driven models, the behavioral models. But I teach very different courses. I teach a corporate finance class, which is about talking about how to run businesses, the first financial principles that drive how you run a business. I teach a valuation class about how to value assets in businesses. And I also teach an investment philosophies class about how to approach investing in the market. And I'm constantly on the search for something that will help me explain everything I see in all three disciplines. I might be overreaching here, but one of the things I've found useful in explaining how companies behave, how investors behave and misbehave, is the corporate life cycle. You're saying, what are you talking about? The corporate life cycle in many ways mirrors the human life cycle. A startup is like a baby. A very young company is like a toddler. An adolescent company is like a teenager. Then you're at the peak of your life. Then you hit middle age. And then you get old. And this part you might not like, but you start to decline and eventually you die. Companies move through the life cycle. And in fact, I would argue there are 6 phases to the life cycle. Why only 6? You could come up with 8 or 10. In my version of the life cycle, just to keep it something adaptable, I have 6 phases. The startup phase, we have an idea for a business but haven't thought of how to convert into a product or a service. Then if that idea makes it into the product service, then you're in young growth, or you try to build a business model to deliver revenues and monetize that product or service. If you make it through that phase, call it the bar mitzvah moment, where you basically become a business. And the question is, can you make this business larger? Can you scale up your model? Some businesses don't, some businesses do. And then you get to mature growth, where you now have a pretty large business and your scaling up opportunities start to get limited and you look for growth in other ways. then you become middle-aged, mature, stable companies, and then you go into decline. I am going to use this framework to try to explain how companies change or should change as they age. Incidentally, in 2022, and I'm going to emphasize the year, these were examples I could give for each. AI was just starting, and many AI companies were in their startup phase. They were ideas, not quite businesses yet. A company like Palantir and maybe Airbnb, just maybe making a transition, but still young growth. Tesla and Nvidia had made that transition into high growth. Google and Facebook were mature growth companies. What does that mean? They'd succeeded, they'd become larger, but now they were struggling with scale. Then, of course, you have mature, stable companies, Coca-Cola, Walmart, successful companies, but in a sense, middle-aged. And of course, in decline, I pointed to Exxon and GE. GE because it's a 130-year-old company and its best days are behind it. Doesn't make it a bad company, but it is where it is. And ExxonMobil because the forces of nature and climate change are working against it. I'm going to argue that much of what you see in business can be explained by where you are in the life cycle. Now, before you apply the life cycle, though, you might say, well, how will I know where a company is in the life cycle? I'll give you 3 variants you can use to make that determination. Each has its pluses and minuses. The first is you can look at the corporate age, the time between when the company was founded and today. So if your company was founded in 2000, in 2024, you're 24 years old. Implicitly here, you're saying younger companies are more likely to be early in the life cycle than older companies. The plus of this approach is incredibly simple and intuitive. The minus is companies don't always age at the same rate, as we will see in a couple of minutes. But chronological age is a good starting point. The second approach that people use to decide where a company is in the life cycle is to look at what industry group or sector the company is in, and then make a judgment based on the industry group or sector. For 4 decades now, if you told me you were a tech company, I automatically put you in the growth column. Why? Because technology companies are considered to be growth companies. Again, you could argue that there are some industries in some countries which are in higher growth than others. So if you're from that industry or country, I'm going to call you a high growth company. But here's the catch again. Just as companies age, industries age. Technology, which used to be almost entirely high growth 30 years ago, now is a mix of companies in it. There's a third way you can classify your company. This is perhaps the best way, but it requires the most work. You can look at its operating metrics. What do I mean? High growth companies, young companies will tend to have high revenue growth and often not have high margins yet because they're working on the business model. So if you have high revenue growth and low or negative margins, you're more likely to be a young company. If you have low revenue growth and pretty stable margins, you're more likely to be a mature company. I've actually found that corporate age works relatively well because if you look at the operating metrics, young companies tend to have high revenue growth and low margins. Doesn't make it a perfect measure. But if you look at a company, you can try at least to put it on the life cycle. As I said, I teach 3 different classes, and in each of these classes, I've found that the life cycle helps me explain what happens. Now, before I look at those applications or the implications, let's look at what drives the corporate life cycle. When I look at a corporate life cycle, I measure it on 3 dimensions. The first is the length of the life cycle. How long does your business last? And let's face it, there are businesses that last hundreds of years. There was a Japanese shrine maker who created in, I think, 581 AD and eventually went out of business about 20 years ago. It's around 1500 years. There are technology companies that flare up and then go away. 5 years, 10 years, they're gone. Think Peloton. So let's look at the length of the life cycle. The second is the height of the life cycle. How big can you make your business? Again, wide differences across businesses. Some businesses can scale up more. They can become much larger. Other businesses scale up less. One of the things that technology has given us is companies that can scale up more in businesses where scaling up is difficult. Think of the largest car service company 20 years ago. Probably a taxi cab company in London or New York. But then along came Uber and Lyft. And Didi, ride-sharing companies, could get much larger because technology allowed them to operate in hundreds of cities. So there's the length of the life cycle. How long does your business last? The height of your life cycle. How big can it get? And this is the third factor, which is the slope of the life cycle. What does that measure? How quickly can you climb from where you are now, a startup, to being a large company? That too is driven by external factors. If you're in a capital intensive business, you're an infrastructure company, you have to build toll roads or factories, it'll take you a lot longer to scale up than if you're a technology or an intermediary company. So when you look at the life cycle and you think about the length, the height, and the slope, it's driven by forces that are often outside your control as a business. One final point, and we'll talk more about this, you can already see that some business models will scale up quicker and become larger than other business models. Now you're already attracted, right, to those business models that can scale up quicker and get larger. There's a catch. Those life cycles which can scale up quickly are often the ones that also scale down quickly, because the same forces that allow you to scale up quickly, low capital intensity, no customer inertia or loyalty, will also result in your business scaling down quickly. Now, about a decade ago, I used this process to talk about the difference between the classic 20th century company and the 21st century company. Think of the classic 20th century company. GE was actually founded in the 19th century, but let's make it a 20th century company. Lasted 130 years. It took them a long time to get from nothing to big. They stayed at the top for a long time. It took them a long time to scale down. You look at the great companies of the 20th century, they tend to be long-lived companies that took a long time to build up. In contrast, think about the classic 21st century company. And again, I'm going to draw on a 20th century company to get started. Yahoo, founded in 1992, became a $100 billion company by 2000 in 8 years. What took Ford and GE 5 decades to do, Yahoo did in 8 years. It's great, right? It lasted at the top for about 3 or 4 years until Google came along and then went into tailspin, and by 2015 it had gone away. I'm going to argue that the classic 21st century company has a compressed life cycle. I describe it as aging in dog years. And it has implications because almost everything we do in business, we teach in business school, or the way we approach valuing businesses, I think is for the 20th century company. I'll give you a personal example from a discipline I work in valuation. The way you value a company, especially if it's publicly traded, is you forecast the cash flows for a period of time, 5 years or 10 years. At the end of the 10th year, you assume the cash flows continue forever. Why? For convenience. And the reason we were able to get away with it for the 20th century companies, if you lasted 80 or 100 years, the value of cash flows over 80 years is very close to the value of cash flows forever. But can we do that for the 21st century company? I'm going to argue not. And in fact, I'm going to argue that a lot of what we teach in business, a lot of the processes and approaches we use have to be adapted to 21st century companies. So with that lead in, let's talk about what it is that companies and investors do differently across the life cycle. I told you I teach 3 classes. In terms of sequencing, the first of my classes is a corporate finance class, where I talk about the first principles that drive how companies should make decisions, the first principles. Now, I actually argue that every decision that a business makes has to fall into one of 3 buckets. An investment decision where you decide where to allocate your resources, what projects to take, what acquisitions to make. Is a financing decision. Ultimately, business can be funded only with 2 ways, debt or equity, borrowed money or your own money. The financing decision looks at the mix of debt and equity that you use. And then there's a dividend decision where you decide how much to return to shareholders or the owners of the business. The investment decision, the financing decision, the dividend decision. And every corporate finance class talks about all 3 decisions. But depending on where you're in the life cycle, your focus is going to shift. For young companies, where the value comes almost entirely from future growth, it's the investment decision that matters. They can't afford to borrow money. They can't afford to pay dividends. It's all about investing. As companies mature and their earnings start to come in, the capacity to borrow money increases, the financing decision enters the mix. Now you start thinking about, is there a better mix of debt and equity for me? And then you go into decline Who cares about investing anymore? You're in a bad business. There aren't very many projects to take. It's about how do I return cash back to the owners. The investment decision, the financing decision, the dividend decision, every business has to make them. But you can see that the focus will shift depending on where in the life cycle. One of the things I talk about is companies that refuse to act their age. And one of the ways to think about companies that refuse to act their age is a young company that constantly thinks about finessing the mix of debt and equity. If you're a young company, why are you spending your time talking about financing mix when you should be talking about investing? Or a mature company that spends all its time looking for growth and investments and not thinking about debt capacity? Or God help us, a declining company that thinks about growing again and investing again. The life cycle explains why companies' focus should change and why when the company's focus doesn't change, your company that refuses to act its age, you can create some real damage. The second class I teach is a valuation class. And there are two things to remember in valuation. First is the value of every business is driven by cash flows, growth, and risk. That's true across the life cycle. But those cash flows, growth, and risk will vary depending on where in the life cycle. The second thing I talk about in my valuation class is how every valuation is a bridge between stories and numbers. In other words, what you might see are numbers in a spreadsheet, but those numbers come from a story you're telling about a company. That balance between narrative and numbers, though, will shift as you move through the life cycle. And here's why. If I ask you to value a very young company's been around 2 or 3 years, there aren't very many numbers that you can look at. There's no historical data, and even the data you're looking at doesn't give you very many clues about what the company can or cannot do. Everything is driven by story. Early in the life cycle, it's a story that drives your valuation rather than the numbers. As companies age, though, and they start putting numbers on the ground, those numbers kind of constrain your story. You're Coca-Cola. You're in chapter 33 of a 35 chapter book. There isn't a whole lot of storytelling left because your numbers drive your story. But here's what it means. If you are in valuation and you're a natural storyteller, remember the stories we're talking about here are bounded stories bounded by numbers. You're going to be much better at valuing young companies. If on the other hand, you're in valuation, it's all about numbers. You love calculating accounting ratios and forecasting 3 financial statements and working with your Excel spreadsheet. You know where you're going to be most comfortable? Value mature companies or declining companies. Recognize that to value companies across the life cycle, you need very different mindsets and skill sets. Which brings me to the other way we put a number on a company. I believe in valuation, but I'm also a realist. I know that most companies are priced. You're saying, what does that mean? The way we attach a number to a company, a business, or an asset is to look at what other people are paying for similar businesses. To do that, though, you have to scale the price to something that you can compare across companies. You're saying, what are you talking about? You've seen price earnings ratios, you've seen EV to EBITDA multiples, you've seen pricing ratios. Those are standardized prices. The way most people attach numbers to companies is not by valuing them, but by pricing them, by coming up with a standardized price and coming up with a peer group that you can compare your company to. That process stays the same because you got to do it across the life cycle. But the pricing metrics you use and the peer groups you use will shift depending on where you're in the life cycle. Let's say you're a venture capitalist. You're trying to price the company that you're going to be investing in. Price, not value. You're saying, what am I going to price it at? Remember, you have no revenues, no earnings. It's a pre-revenue company. You're going to be pricing it on things you think will drive revenues. Number of subscribers, number of users, the total addressable market. Your peer group is going to be other young companies just like yours being priced by other venture capitalists. Pricing is messy, right? For startups, just like it is in valuation. As companies start to deliver revenues, you're going to start to see the pricing metrics shift towards revenue multiples with controls for differences in revenue growth across companies, perhaps even margins. And your peer group is going to be other high growth companies with differences in revenue growth. As you approach maturity and you start to deliver earnings, you're going to start to see initially Price earnings ratios adjust for growth. They're called PEG ratios or maybe forward price earnings ratios. But eventually you're going to see a lot more PE. And as you approach real stability, especially if you're capital intensive, you might see EV to EBITDA multiples. You look at the cash flows before reinvestment. Pricing metrics still, but the type of pricing metric you're going to see will shift. And finally, when you go into liquidation, you're going to see a lot more book value multiples. Perhaps because people think of book value as equivalent to liquidation value. Not a great assumption, but you can see the logic that drives it. When you look at differences in pricing metrics across sectors, why do people use PEG ratios in some sectors, revenue multiples and book value multiples? There's no one multiple that dominates. You're going to see, depending on where companies in the life cycle, one pricing ratio might work better than another one. So both valuation and pricing shift across the life cycle, even though the principles remain the same. That's my valuation/pricing class. The third class I teach is an investment philosophies class. And let's start again by laying some truths on the table. There is no one best investment philosophy. You're saying, but Warren Buffett is the best philosophy. Not necessarily. There are millions of people who've tried to be like Buffett, and none of them have been able to deliver the kinds of returns that Warren Buffett delivered. There are other pieces to the puzzle. So in my investment philosophies class, I talk about why different investment philosophies exist and why one might be better for you than the others. What is it about you that makes that philosophy better? The point I make is to pick the right investment philosophy for yourself. You don't need to understand what Warren Buffett does or what makes Peter Lynch tick. You have to understand what makes you tick. So in investment philosophies class, I talk about a range of philosophies often structured around the investment process. The philosophies can be market timing versus stock picking. Within stock picking, you might use charts or you might base it on fundamentals. Within fundamentals, you can look for value or you can look for growth. Or your investment philosophy can be built around the execution phase where you think the market's making mistakes and you try to lock in market mistakes. Arbitrage. Which one's right for you? I mean, first, before you look across it, think about what it's going to lead you to do. When you look across the life cycle, you're going to see that investors, first, the balance between investing and trading is going to shift. Early in the life cycle, when uncertainty is greatest, trading is going to dominate. If you're an investor in a very young company, you're going to be the exception. As companies mature, you're going to see the mix start to shift as investors start to enter the game. Finally, in decline, you'll see mostly investors. When you look at the investing focus, for startups, it's venture capitalists, activists, people who are involved in the company being run. Young growth, you're going to see IPOs show up. And then you're going to see companies in the public marketplace, and they can range from public growth to public value to public declining. And in some cases, those public declining companies might be taken private. And if you're a trader, your focus is also going to shift. Early on, it's going to be, as a venture capitalist, you're basically trying to play the momentum game. I've always argued that what makes for a successful venture capitalist is timing, getting in at the right time, getting out at the right time. Even once you go public, as an initial public offering of a young company, it's momentum trading that you're trying to focus on. What does that mean? You try to climb the ladder as the stock goes up, and you try to get out before there's a correction. With more mature companies, the type of trading will shift. You'll see a lot more trading around earnings announcements and big information announcements, information trading. And in decline, you'll see a lot more traders trying to take advantage of mispricing across markets. Often with the same company, but with different securities. Buying equity and selling convertible bonds issued by the same company. Convertible arbitrage. So as you can see, depending on what kind of choice you make in investment philosophy, you're going to spend more or less time in some phases of the life cycle than others. You might say, so what? There's nothing inherently good or bad about getting focused in a stage of the life cycle, but you need to stop lying to yourself. If you are a value investor, an old-time value investor, you look for stocks that trade at low multiples of earnings and book value, you're going to end up with a lot of mature and declining companies in your portfolio. Now, there's nothing wrong, as I said, with that. But with the mature and declining company portfolio, you're going to notice two things. One is that there's a lot less volatility because your companies are pretty stable, much of the value is on the ground. but you're not going to get any 10 baggers. It's delusional to be an old-time value investor and expect your stock to go up tenfold. It might happen, but it'll be purely accidental. If, on the other hand, you're a venture capitalist or you invest in very young companies, first, you got to spread your bets. You can't be concentrated. And once you've spread your bets, you're going to recognize that a big chunk of your portfolio ends up essentially getting wiped out. But your big winners are huge. It's a very skewed portfolio. I think as investors and traders, we need to be honest with ourselves. First, be clear. If you're a trader, you're trading. You want to use trading tools. You're playing the momentum game. If you're an investor, what kind of investor are you and what kinds of companies are you going to get in your portfolio? The last component that I want to talk about is managing across the life cycle. Now, if you listen to the management experts at the Harvard Business School or McKinsey, the consulting firms, the very top business schools, including NYU, now, they sell you the mythology of this great CEO. In fact, I've read at least 15 or 20 Harvard Business Review articles and McKinsey articles about, hey, these are the 8 characteristics that make for a great CEO. Now, it's very self-serving because it serves their purposes, right? Why? Because why do you go to Harvard Business School? Because they'll teach you all these characteristics so you can become a great CEO. You call in McKinsey, you pay them millions of dollars. Why? Because they're going to give you advice on how to be a great CEO. But it's a complete lie. And here's why. What makes for a great CEO depends on where you are in the life cycle. If you're a young company or a startup, you need a visionary at the top, right? Why? Because you're selling vision. You got to convince customers, employees that your story is going to become a company. It's a visionary that you. As you get a little further down the life cycle, you got to convert the vision into products and services. You need a pragmatist at the top. Pure visionaries will never build businesses because they refuse to compromise. So you've gone from a visionary to a pragmatist. You got your product or service. You want to build a business model. You want somebody who can build business models, right? Build supply chains and manufacturing. A very different focus. You need somebody who's a builder. You make it through, you build a larger company. You've now scaled up. You're looking for new growth. You've got to be an opportunist. Find new markets and new products to get that extra growth. And now you're looking at a mature, stable company. You've got to play defense. Everybody's coming after your market. You've got to understand what your competitive advantages are, your moats are, and protect yourself. And finally, in decline, you need a CEO with absolutely no ego, doesn't want to build an empire, who's okay making his or her company smaller. You want the liquidator. You tell me where you're in the life cycle. I'm going to argue that the kind of CEO you should be looking for should be very different. Now, one of the things I'm going to also argue that you can get mismatches. Why do you get mismatches? Because the company ages at a rate that's different from the CEO. So let's say you have a CEO who refuses to get older, but the company gets older. You got a problem. You might still have a visionary running a company which needs a builder or an opportunist or even a defender. You can get mismatches because the company and the CEO don't age at the same rate. You can also get mismatches because you get the wrong person hired. The board of directors hires a CEO based on reputation, but it's a reputation built at a very different type of company at a different stage in the life cycle. When you have a mismatch and that mismatch is not fixed, it can be deadly for the company. So one of the things we're going to talk about is why those mismatches are going to get more likely in the 21st century. Because the corporate life cycle has become more compressed. Now, in the 20th century, time took care of the problem, right? Henry Ford was the perfect CEO for Ford when it started. Young startup, you need a visionary. But he was outliving his welcome towards the end of his stint as CEO. But time took care of the problem. He moved on. Another CEO came on. With long-lived companies, time takes care of transitions. But remember the Yahoo example? Or you can think of BlackBerry. Companies that come out of nowhere to become large companies and then face maturity and decline very quickly. You might have the same person running the company. I'm going to argue that the compressed life cycle can be used to explain why you're going to get so many more management frictions in companies. Corporate governance is going to become much more of an issue in the 21st century. Finally, the life cycle brings with it this issue of aging. And the advice we get as human beings, you got to age gracefully. I'm not even sure what that means. But there are 5 possible pathways you will face as a company, especially as you get to the later stages of the life cycle. The first is acceptance. Accept where you are in the life cycle, behave accordingly. It's easier said than done, because acceptance might be okay when you're a mature growth company, but are you willing to accept when you're a declining company that your best days are behind you? It's tough to do, right? Which is one reason why in many of these companies you get denial instead of acceptance. What does that mean? You're a declining company, but you deny it. You blame other people. You blame outside symptoms. You basically assume that things are going to go back to the way they used to be. You behave like you were when you were younger. And it's incredibly value destructive. When denial doesn't work, you try desperation. What do? You throw stuff at the wall and hope something sticks. You do a big acquisition. You enter new businesses. You're effectively gambling. And this is especially the case when you're using other people's money. You make long odd bets on becoming young again. You know who aids and abets you in this process? There's an ecosystem of bankers and consultants who are trying to wean you away from acceptance into denial and desperation, because they make a lot of money in that process. And you know what they hold out as promise? They say, you can be young again, and they can give you examples of companies that have reincarnated themselves in the past. And when I name these companies, you'll see they're legendary. IBM in the early 1990s with Lou Gerstner as CEO. Apple in 2000, Steve Jobs, legendary CEO. Microsoft in 2013 with Satya Nadella as a new CEO. Did they reincarnate themselves? Yes. And that possibility exists with the corporate life cycle. It might not with the human life cycle, but it does. And often these companies become case studies that get offered to other companies that you can be the next Apple, the next Microsoft. I think a lot of money is wasted trying to be the next Apple or the next Microsoft, but you can see why it's so alluring. Because as a CEO of a publicly traded company in decline, don't you want to be the next legendary CEO? But there's a final response to, especially to aging, which is you mistake your end game as a business to be survival. And I'm not a great fan of sustainability, especially when it takes the form of corporate sustainability. Climate sustainability I can understand. Corporate sustainability makes no sense to me. Why would you want a company to last forever? It's a legal entity. If the reason for your existence is gone, just please leave. When you mistake your end game as survival at any cost, guess what? You will survive at any cost. You'll end up a zombie. There are parts of the world where you have zombie companies sucking up resources that should be going to companies that can really use them better. So corporate life cycle to me, and I might be overreaching here, is a device that you can use to explain a great deal of what you see around you in business, in investing, and in managing. At this point, you're saying, what now? Now, if you watch this video and you have neither time nor money, remember, as we have 2 constraints. One is a constraint on time, the other is a constraint on money. If you have neither time nor money, I wasted enough of your time already. You got the gist of my thinking on corporate life cycles. You're done. Move on. If you have time but no money, I have a choice for you. I have a class that follows this session with 20 sessions of about 25 to 30 minutes. I'm sorry, I'm just verbose. My sessions are longer, which essentially has all of the material in the book in the form of a class. You can watch the sessions. There are even exercises you can do so that you can develop your own corporate life cycle framework. So that's if you have time, but no money. If you have time and money, maybe you'll take the class. And if you're interested, and again, I'm not overselling the book. If you want to, I have a book that contains my thoughts about the corporate life cycle from Penguin Random House. Should be at a bookseller around you starting August 20th of 2024. And there's going to be an Indian edition in a couple of weeks, so watch out for it. So if you have neither time nor money, you're done. If you have time but no money, take the class. If you have time and money, then I'll take the class, and if need be, use some of that money to buy the book. He's saying, what if you have money but no time? Come on, then why are you spending that time watching this video? Move on. Spend that time on friends, family, and living your life. Remember, you have a life cycle too, and time is that ultimate constraint. Whatever you do, though, I wish you the best. And I thank you very much for listening.